Welcome to my channel. I'm the cover call guy. My goal is to create a $120,000 per year passive income using only cover call ETFs. My portfolio currently yields about $70,000 a year and about $6,000 a month. Before we get started on this video today, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online and I could be completely wrong. Now, with that out the way, today's video is going to be on my thesis, Stagflation 2.0, my 2026 income thesis for SPY and why it can possibly double. All right, the 2026 macroeconomic case, right? Because we're in such an higher environment where it could possibly lead us to a stagflation environment. It's the high altitude stall. What this just means is that a 2026 my investment case is not built on bullish outlook, but it's actually built on a high altitude stall where the Fed is trapped by its dual mandate. The pivot delay, that's what we're going to go off of, the Fed's pivot delay driven by slowing growth and sticky inflation, creating a high uncertainty regime that is uniquely problematic for traditional 60/40 portfolios, but ideal for volatile harvesting strategies such as a cover called ETF portfolio, right? So this is just the sources I'm using. It's a slowing growth from JP Morgan. They forecast a mediocre, maybe a 1.6 at best for US GDP growth in 2026. Bank of America is still warning of very, very sticky inflation with a core PCE will be stuck above 3%. And that's if you believe it's still 3% from the government data, right? And 3% in the first half of 2026, well above the Fed's target 2%. And then the hawkish Fed, the JP Morgan's median forecast shows only one rate cut in all of 2026, maintaining a higher for longer policy. All right, why is this macro case is critical for SPYI? This mild stagflation is not a macro forecast; it is the real feel for SPYI's income engine. These drivers are the primary source of the persistent high market volatility. Which is the VIX, right? That's what we track the VIX for implied volatility, right? So that determines our cover calls premium, right? So that SPYI is designed to harvest. Without this pressure from the VIX, volatility collapses and the income thesis disappears. So it is very crucial that we monitor how the VIX react coming 2026, and that plays into higher tariffs, which is just policy drivers like trade wars, like the tariffs, or inherently stagflationary. They raise the cost of goods and fuel consumer price inflation, creating policy noise and market volatility. Immigration restrictions constraining the labor supplies slow the potential GDP growth while simultaneously pushing wage higher, contributing to the sticky inflation that traps the Fed. And then death of the Fed put, which just means high inflation means the Fed cannot easily cut rate to support falling asset prices. Right, the high uncertainty is the primary driver of a sustained market volatility, which is the VIX. All right, how SPY works, right? Volatility is the feel, like most cover call ETFs. So as you can see here, VIX below 15 and then VIX above 25. So below 15, as you can see, the SPYI's distribution is funded by option premiums. When the VIX is high, premiums are more expensive, allowing SPYI to collect a much higher income, right? So you can see it just doubles when the VIX is above 25. Deconstruction, the active mechanism, right? That just means that the active strike selection from SPYI, unlike passive funds like XYLD, locked into selling at the money, NEO's managers actively select strike prices. They can sell further out of the money to balance upside or closer near the money to maximize premiums, adapting to the market. And there's active expiration management, right? The fund isn't locked into a rigid monthly cycle, Managers can use shorter dated options, such as weeklies, to harvest premiums from specific volatile events like Fed meetings or CPI reports, then roll positions as needed. And then the 2024 strategy pivot. I don't think a lot of people actually know this about SPYI. The fund evolved from a call spread, which funded upside in 2023, to primarily selling cover calls. This is a deliberate shift to maximize income for 2026, for the possible 2026 stagflation thesis, right? Sacrificing upside to boost yield. The structure and tax mechanism. We always got to talk about the tax mechanism when we talk about NEOs, because that is what they're known for. The first advantage is Section 1256 tax efficiency. This is how SPYI uses SPX index options, not the SPY ETF options. It classifies them as 1256 contracts, which then unlocks a profound tax benefit, right? The 60-40 blended rate. 60% of it is long-term and 40% is short-term. So you are taxed more efficiently. You keep more of your money. And then, of course, for higher bracket investors, this results in a blended rate of 26%, but it's still much better than ordinary income, 37%, which is like a W-2 worker, if you're an employee. Advantage 2, return of capital, right? ROC. A lot of people don't like that word because of NAV erosion. So we got to know if it's good or bad, right? This distribution, often classified as a return of capital, which is a powerful tax deferral feature, not a sign of weakness here, right? SPYI and the news team has been doing amazing with ROC, right? When it is distributed, it is not a taxable event in the year received. Instead, they lower your cost basis. Taxes are only paid when you sell, allowing your full gross distribution to be reinvested and compounded. All right, and then SPYI's defensible moat, a deeper dive on tax. This dual tax advantage is SPYI's most defensible moat for high net worth investors that we all are going to be. If you're watching, you're subscribing, we are all going to be high net worth investors, all right? Say it, repeat it, believe it. All right, after tax yield is significantly higher than competitors like JEPI, which is taxed as ordinary income. Disgusting. Here's what really matters, right? The tax drag on competitors. For example, JEPI's yield is actually misleading. Taxed at an ordinary income of 37%, investors can lose over a third of their yield to taxes annually. This is a tax drag. Means 10% pre-tax yield becomes a 6.3 post-tax. Right? A lot of that matters. The power of ROC deferral, right? Return of capital. SPY's ROC status mean a tax event is deferred. All right, deferred, not deleted, right? You still have to pay it at some point. However, I did make a video. Please watch my video on how you can actually never pay it. I have a video on that. You pay no tax on the income annually. This allows 100% of the distribution to be reinvested, creating a tax-free compounding effect that competitors cannot match. The 60-40 blended rate, when tax is finally paid upon selling the ETF, it is at a favorable 60-40 blended rate, about 26%. You pay a lower rate and you pay it later. This combination is the structural alpha generator. I made a video on this, on how to pay nothing on return of capital. Give it a watch. I think you'll like it. All right, 2023 performance, right? We're just here using this data to prove SPYI to SPY and its manager skills, right? It shows that SPYI's original strategy decisively beat its direct competitors, JEPI, XYLD, and there's a whole bunch. I'm not going to list them all. And in bull market, right, it proved manager skill from NEOs, right? It showed that NEOs managers can skillfully balance income and upside, right? It was a win-win, outperforming JEPI by nearly 2 times. Then the following year, it validated the 2024 pivot, right? The new pivot to primarily cover calls is a deliberate choice, and it confirmed the 2026 thesis. So if 2026 actually happens with what I'm thinking, with my thesis, NEOS is sacrificing this 2023 style upside to maximize income for the high volatility stagflationary environment we see coming. Critical update, the 2024 strategic pivot. I just want to go a little deeper. What changed, right? So in late 2024, SPYI's strategy evolved from its original call spread to call spread overlay to primarily selling cover calls. This is a material shift in its approach. It's just not talked about a lot, especially with a lot of these SPYI investors and YouTubers and Redditors and people on X. They don't talk about why SPYI is good, right? It just talks about its tax advantage and all this other stuff. But all right, this pivot makes SPYI's payoff profile more like an active XYLD, with its key differentials now being active management and a tax advantage, not upside capture. The impact on this for 2026 projection, I think, will be increase income potential by focusing more on selling calls. The fund can harvest more premiums, strengthening the high yield thesis. However, there are some reduced upside capture. This change reduced the fund's ability to participate in sharp bull rallies. The 2023 performance is less predictive of future bull market behavior because it is a change of strategy. It was a change of how they want the ETF to operate in their NEOS image. So basically, maintain the NAV, grow the NAV a little bit, but we want the income. Like my catalyst for 2026 VIX spike and my doubling thesis. One is the trade and tariff shock, right? Aggressive, broad-based 10% plus tariffs would inject massive, unquantifiable uncertainty into corporate earnings and supply chain. The labor market deterioration, right? A sharp rise in unemployment, month over month of 0.5%, triggering the SAM rule, which shattered the soft landing narrative that the Fed has been saying for like 2.5 years and force a market repricing. And then of course the corporate credit stress, right? The Fed owns 2026 stress test models. The Fed's own 2026 stress test model models a 5.7% corporate bond spread widening, an event that would correspond to a VIX spikes above 70, which would be crazy. And that's what it would be crazy. In other words, if you don't own credit cover call ETFs, right? We love that VIX spiking, right? We love the ups and downs. That's what makes the cover call payouts juicy, right? We want that juicy payment. All right, my 2026 scenario analysis with the VIX pretty much spiking. So VIX 15 to 20 would be a bull. VIX 20 to 25 is the base model. VIX 25 to 30 would be stagflation area, and then VIX 30 would be extreme crisis. The doubling of income, which is we need around like 20% plus, is a low probability, right? The crisis scenario. The core thesis rests on the stagnation case, which we need the VIX to be 25 to 30, creating a 16 to 20% yield. So we need the crisis to happen. I think it could happen around stagflation kind of area with the VIX being 25 to 30, because once we hit that stagflation, a lot of things are just going to start snowballing. Once we get to around 25 plus, then we're going to start seeing trouble, and I think it can snowball. All right, and this is just a 2026 consensus macroeconomics forecast. It's just data I took from JP Morgan, Bank of America, Goldman Sachs, and the CBO. Pretty much we kind of need this to actually happen if this thesis were to actually pull through, and for any of SPYI holders to have that nice doubling. Right. Risk 1, the downside protection myth. I just want to, for the new investors, welcome to my channel. This is all about cover call ETFs, and a cover call strategy does not provide profound downside protection, right? Like puts do. It's meant to buffer while giving you some income, right? Its value is in providing an income buffer that creates a relative outperformance, right? SPYI launched on August 30th, 2022, after the S&P 500 had already experienced majority of its 2022 decline, right? Its negative almost 3% return is accurate, but misleading, right? A better proxy would be QYLDs, lost almost 20% in 2022, and then pretty much, right, collecting a lot of income from it. So SPYI did pretty well. It was a little misleading just because of how a lot of people think that is going to provide a good cushion, like a hedged, but it's not. Understand it's not. It's good for recovery. I think this is one of the reasons why they kind of switched and pivot for the strategy. Well done to Neos. And in the framework, this is the correct framework for 2026 bear market. Right, we gotta understand that it's not a capital preservation, but a high income stream that cushions the total return loss. Right, we're not here to try to match the growth of the bull market growth stocks. All right, risk two, the upside sacrifice. Again, if you're new to cover call ETFs, cover call ETFs does come at a trade-off, right? Capped upside. That just means that the strategy is ideal for range-bound or modestly rising markets, but will underperform in strong bull markets, right? Bull market underperformance, such as the 2024 strategy pivot, less upside capture, means SPYI will significantly underperform SPY in 2026 scenario. And then of course fluctuating income, right? The payments, what it distributes are dependent on market volatility, right? The VIX, and it can decrease in calm periods. The trade-off, investors are explicitly trading upside potential for a high tax efficient current income stream. So I understand these trade-offs. I'm okay with it. I don't really care about growth stocks right now, or at all really. I might in the future. I don't know. I don't really. I make about $6,000 a month with a goal of 10, and then after I hit 10, I want more, right? So if I can maintain that, I really don't care about growth because I can actually live my life, spend the money. All right, risk mitigation and positioning. So we got to ask, what if we are wrong, right? What if I am wrong? Given the structural trade-off, SPYI is best used as a portfolio component for income, not for core holding for growth, right? Position sizing, most suitable as a 10 to 25% satellite allocation to an already existing core equity, right? To SPY, that's if you hold SPY. But if you don't care you're wrong, then I wouldn't hold SPY like myself. I don't care if I'm wrong. I'm just gonna double down on it because I love SPYI, right? Pairing strategies, combine SPYI for income with a core S&P fund for growth to balance the portfolio's objectives and mitigate upside sacrifice. Right, this is if you're scared, you're wrong, you want to pivot, that you want some safety. This would be the best option for you. Exit triggers, if the stagflation premises break, the VIX remains sustained at below 15. The primary income driver is neutralized, signaling a potential rotation. So again, if if I'm wrong, this is what you can do, right? So you can always go back to growth and hold a little bit more steady. However, if I'm wrong, SPY has been doing great, then I just double down, right? I mean, for me, it's not a lose-lose situation. If I'm wrong, I still win. I just double down on SPYI and collect more income. If I'm right, I double down and collect more income. So these are just for the new nervous investors, right? This is what you can do. Right, my conclusion, it is the right tool for the 2026 job, right? SPYI, core income, and then you have your other portfolio assets. You might not be me and do 100% cover calls, so this is what you can do. The 2026 stagflation thesis doesn't call for a 100% buy and hope strategy. It calls for a specific tool, which is SPYI, to convert volatility into income. In a world of high taxes and high inflation, SPYI is engineered to be that tool, right? While others fear of the VIX being 20 to 25 plus, SPYI is built to harvest it. The 2024 strategy pivot confirms this focus. For investors who believe in pivot delay thesis, SPYI is the core income engine to navigate the 2026 macro environment. All right, I love me some SPYI. I mean, this is my verdict here. I think SPYI is going to emerge as a strategically engineered instrument for the 2026 landscape, defined by its one, policy paralysis, persistent inflation, and sustained volatility. Right, in an area where traditional portfolios falter under a delayed Fed pivot and fading growth, I believe SPYI is going to transform that very instability into opportunity. All right, when there's when there's blood on the street is when you buy, right, and is when you go and deploy a dry cash or dry powder. That's what I plan to do, and then systematically converting high volatility and elevated rates into a consistent tax advantage income stream. So that's it. That's all of my thesis right now. I really have high hopes for SPYI if stagflation starts to catch on. Thanks for watching, guys. Join the conversation. If you like this analysis, please give it a like. Comment your thesis and subscribe for more. It really shows me support and shows me that you appreciate the video. Again, if you agree with the thesis, let me know. If you don't, again, let me know too. I read all the comments, and I don't hate any of the hate comments or angry comments. I love them all. Thanks for watching, guys. Stay tuned. Catch you guys on the next.